Alright, so we are going to look in this video at some Chapter 14 topics. The videos we're going to look at are accrued interest, on the purchase of bonds, and we're also going to look at extinguishment of debt prior to maturity. Extinguishment of debt before or prior to maturity. So those will be the two topics I put in this video. So you may recall, I hope you recall, that before we left for break, I had asked you to look at exercise 14.3, part 2, which was a scenario in which Garfunkel Company had sold some bonds, and they sold them after the bond date. Or in other words, the buyer bought them after the bond date. So let's sort of reset the scenario here. So if this is our period of time, our timeline, we know that on June 1st, 2020, so here's 1/1/20, here's 6/1/20, 7/1/20, and then we'll also do 12/31/20. So on 6/1, the bonds were issued, but the bonds were dated, so they were sort of born on, or the debt sort of began to exist on January 1st. But the lender only lent money to Garfunkel Company on June 1st. So January, February, March, April, May. So this is 5 months out of the 6-month period. Now, what this means is there's really only 1 month in which Garfunkel owes the lender any interest. So this is the situation we were talking about at the end of class. How do you deal with the fact that on July 1st, the interest payment is going to be for 6 months of interest, when the interest owed is only 5 months? And so we talked about two possibilities. One possibility is you adjust the payment so that the amount paid is only the right amount for 1 month of interest, which would work fine if you only have one bond and one lender. But if you're in the Tyson, like we talked about in class, if you're in the situation like we talked about in class with Tyson, where you've got $800 million of bonds and then $2 billion more, so you've got an awful lot of bonds and an awful lot of little bonds out there, your bookkeeper is going to go crazy. It would really be impossible to write a different check for the right amount of interest for each lender. So the way they handle it instead, is to adjust the price upward so that the buyer of the bond pays the first 5 months, or however many are necessary, to the seller, and then the seller makes the complete 6-month payment. On 7/1/20. All right, so that's the situation we were in. So let's look at the numbers for Garfunkel. So they issued $100,000 worth of bonds on June 1st, and they were 12% 10-year bonds. and they were issued on June 1st. So $100,000 times 12% times how much interest? Well, 1, 2, 3, 4, 5. My months are not obviously to scale, but 5/12 equals $5,000, and this is the accrued interest. The bonds were sold at par, which means the purchase price of the bonds themselves is $100,000. But then what the buyer is going to do, the buyer is actually going to pay $100,000 plus $5,000, and so the total amount paid that Garfunkel gets is $105,000. And so Garfunkel's journal entry is going to be cash. They're going to get cash of $105,000. But they only have bonds payable of $100,000. So what do we do with our extra $5,000? There's a couple different ways you can do it. One way you can do it, the sort of the most obvious way that might come to mind, is you could call it interest payable. And what that means, if you did it that way, is then when you made your July 1st payment, you would end up paying $6,000 of interest and paying off the payable. That's one way to do it. It's perfectly fine. It makes sense. Another way to do it that's a little bit more interesting, I think, and I think is more the default approach, is instead of calling it interest payable, we would call it interest expense. And we would put a credit into our interest expense account, which we don't normally do. But now that you're in major level classes, you're going to start seeing some weird things. So what happens if we put our credit into interest expense? Well, we're going to put our $5,000 credit into interest expense. Then we make our normal 7/1 interest payment. Remember, the whole point of this accounting method is to make our interest payment on our first interest payment date as normal as possible. What you don't want to have to do on 7/1 is have your bookkeeper go through and figure out how much interest payable am I paying off, how much interest expense am I recording. So if you record this initial credit as interest expense and you put it in the interest expense account, then when we make our normal 7/1 payment and put $6,000 of interest expense in there, what's going to net into our interest expense account? We're going to have a net interest expense of $1,000, which is exactly what we want to have. So doing this approach, putting the accrued interest into interest expense instead of interest payable, what it does is it allows us to make our 7/1 entry normal. Both in the amount of cash that we pay out and in how much we call interest expense and all that kind of stuff. So basically our 7/1 entry is just going to be a debit to interest expense for $6,000 and credit to cash for $6,000. That entry is not affected at all by the fact that the bond was issued 5 months late. So that's why we're going to do that. So our first entry to record the issuance of the bonds, it's going to be this guy right here: debit to cash, credit to bond payable, and a credit to interest expense. That's going to be our first entry. The next thing we're asked for is the payment of interest on July 1st. And again, as I've said several times now, the whole point of the accounting that we're doing is to make this entry normal. So we're just going to debit interest expense and credit cash for $6,000. And that entry is just our normal 7/1 entry. And then the third thing we're asked for, so this is part B, and the third thing we're asked for is the accrual of interest on December 31st. And again, that's just going to be our normal interest expense and interest payable entry of $6,000. By the way, the $6,000, how do I get that? Equals the $100,000 face times 12% times 6/12. All right, so that's exercise 14.3. Again, the point of the accrued interest accounting is to make all the accounting after the issuance of the bonds as normal as possible. All right, the other topic I'd like to cover on this relatively short video is going to be extinguishing or redeeming debt prior to maturity. Extinguishing debt prior to maturity. In plain English, this is paying off debt early. By the way, as I think about plain English stuff, one thing that will be a big help to you in your career, this is just because we're not meeting in person doesn't mean I'm not going to give you unsolicited career advice. Learning to speak in plain English and learning to speak in accounting ease and being able to go back and forth between these is going to be a huge help in your career. You're going to talk to other accountants, and other accountants are going to have a tendency to talk in accounting language that they learned in their accounting classes and that shows up in the formal accounting standards and goes into financial statements and that kind of thing. Normal people who are not accountants don't tend to have the same language for things that accountants do, and there's no reason they should. That's not an insult or a criticism of them. But the more you can sort of go fluidly back and forth between formal accounting jargon and plain English, find clear ways to explain to people what you're doing. This will help particularly, in my experience, particularly helps in the audit side when you're talking to even bookkeepers who know some accounting language but don't generally live in that world, or especially if you're talking outside the accounting department, you're going to warehouse people on inventory observations, or you're talking to salespeople or production people, and you're asking questions. Don't expect them to know accounting language, so speak in as clear and plain a language as you can to help them understand what information you need, what your concerns are, what you're asking for, that kind of stuff. Plain English is always helpful. All right, so back to the topic, so rant over. We've already talked about extinguishing debt at maturity. So if you go back into all your prior notes, every time we got to the end of a bond's life, I tried always to make a point to say, what's the final entry for the bond? And the first thing we have to do is update any interest or depreciation, interest or amortization. How often do we update interest or amortization? Always, that's right, so always. And then the second entry is we just write off the debt. So write off the bond payable. And it's always just been a debit to bond payable and a credit to cash for whatever the face amount of the bond is. And you can look back at prior notes, and you can see that we've done that several times. Now, that's always been true at maturity. So when the bond reaches the end of its term and everything goes according to the bond documents, and you pay it off at its maturity date, that's what should happen. But what happens if we do it prior to maturity, if we pay off the debt early? Now, most debt is allowed to be paid off early. Certainly if you buy a house or you buy a car, student loans, any of your sort of consumer debt, generally that's able to be paid off early. And broadly, I think most even business-to-business debt is available to be paid off early. Most banks are not going to complain if you give them their cash back. The downside for that, obviously, is they no longer have the opportunity to invest in your bonds and make interest, but they can go back and turn around and invest that money somewhere else. So lenders are generally okay with the option to get their cash back. Helps them feel safer. What if the bond is written off before maturity? Now, or paid off. there are a couple things we have to consider. First of all, what is the carrying value of the bond at the payoff date, at the extinguishment date? Then again, that's going to be face value plus any premium or minus a discount. All right, so that's what we have to worry about. If the bond was sold at par, obviously premium and discount don't matter. But if it was sold at a premium or discount, there's going to be some unamortized premium or discount. So there's one thing we've got to figure out is what's the face value. The second thing we have to determine is what is the reacquisition price. So do we pay back? Do we buy off the bonds at face, which we would say at 100, or do we buy them back at 99 or 98? Do we pay some lower percentage of face value, or maybe we might have to pay them off at 105? And that's all just going to depend on the terms of the bond. The buyer and the seller, the lender and the borrower, would agree in the bond contract what the bond payoff terms are. So in the Tyson prospectus, I looked at it real quick, and it says that they can redeem them essentially at 100%, plus any interest accrued that hasn't been paid since the last interest payment date. So that's going to be in the terms. All right, so we have to consider those two things, the carrying value and the reacquisition price. How much is the company going to pay? Now, if the carrying value is not equal to the reacquisition price, which it generally is not going to be. In other words, if the amount of cash that you pay to get rid of a liability is not the same as the amount of the liability, then you're going to have a gain or a loss. All right, and that shouldn't be surprising. That's pretty standard. Same thing with the asset. If you sell an asset, if the amount of cash you get is different from the book value, you've got a gain or a loss. This is going to work the same way. So the gain or loss is going to be equal to the reacquisition price minus the carrying value or the book value at date of redemption or extinguishment. And redemption, extinguishment, all those kind of things are synonyms. All right, so let's take a look at an example of how we're going to do this. So we're going to look at brief exercise 14.9. Brief exercise 14.9. On January 1st, 2020, Henderson Corporation redeemed $500,000 of bonds at 99. At the time of redemption, the unamortized premium was $15,000. Prepare the corporation's journal entry to record the reacquisition of the bonds. So here's the first time I'm going to ask you to answer a question in your notes. So notes question number 1, and this won't surprise you, calculate the gain or loss. So I'll count down, tell you when to pause. You can pause the video, calculate the gain or loss, and then restart. So 3, 2, 1, pause. All right, now that you have paused the video and you've calculated the gain or loss using what we just gave you, let's go ahead and calculate this for you. So we can use the same basic format that we used for assets. So in assets, you had the selling price minus the book value is gain or loss. So we'll do the same kind of thing. What's the reacquisition cost or the redemption cost or price? In this case, we're told it's 99% of $500,000. So that's $495,000. So that's the reacquisition price. What's the carrying value? Well, the face amount is $500,000 plus the premium that had not been amortized up to this date is $15,000. So it's $515,000. That is the carrying value. So 495 minus 515, that gives us an absolute value of $20,000. Now, is this a gain or a loss? Well, again, don't get hung up on positive or negative. It kind of depends on the order you stick in your calculator in is going to change. Well, first of all, I don't need to use a calculator. Anyway, don't get hung up on positive or negative. Think about it this way. It cost me $495,000 to get rid of a $515,000 liability. I used to owe $515,000, but I can pay it off for $495,000. Am I better off or am I worse off? Well, I'm better off. This is a gain. All right, instead of having to pay the $515,000 liability on my books, I only have to pay $495,000. If you get baffled, think about your good friend, assets equal liability plus equity. If my assets are going down by $495,000 and my liabilities are going down by $515,000, what has to happen in order for my journal or for my kind of equation to be in balance? My equity has to go up by 20, so I have to have a gain, right? So that's the way that works. So that's notes question number 1 is you calculate the gain. So now that we've got the gain, let's do notes question number 2. What is the journal entry itself? To record the extinguishment of the debt on this date. And as before, like we did with selling an asset, the calculation kind of gives you the journal entry. All the pieces, parts you need for the calculation are in the journal entry, so just kind of think through what to do. So we'll give you a countdown. You can pause, write down your answer, start the video again, and we'll be done. So 3, 2, 1, pause. All right, so now that you have done that, we'll go ahead and write down the journal entry for brief exercise 14.9. Let's start with the easy part first. We know that the cash that we're paying is $495. We know we're also writing off bonds payable of $500,000. We're also writing off the premium. It's the adjunct account, not the contra account. It's an adjunct account. It goes in the same way. So premium is $15,000. We also know we have a gain because we figured that out. Gains make our income statement happy. Which kind of entries make our income statement happy? Debits or credits? Well, revenues are credits, therefore credits make our income statement happy, so gains are credits. So we have a gain on redemption, and that's going to be $20,000. Now, obviously, if the amount of cash were a lot higher, if the cash were $20,000 higher, if it were $515,000, we'd have no gain or loss. If the cash were more than $515,000, we'd have a loss, and then that journal entry would have to need a debit over there. All right, so that is the first couple topics we're going to cover. Now, the next video Redemption of bonds is not always quite that simple. We didn't really have to do any major calculations here, just some subtractions. So as a way to both review everything we've covered in bonds, to do an amortization of a premium and do another amortization table and look at redemption, we're going to do a bigger problem next. But this is all I'm going to cover on this video. So you've got 2 questions for chapter 14 here.